The safest time to invest can feel like the moment when markets finally become calm. That feeling is understandable, but the conclusion is incomplete. When markets fall, people wait for conditions to improve. When markets rise, they wait for prices to become cheaper again. The reason for waiting keeps changing, but the result stays the same. Cash remains uninvested, while the perfect entry point never becomes obvious. Successfully timing the market requires getting two decisions right. You must know when to leave and when to return. Avoiding a decline does not complete the strategy. If you miss the recovery while waiting for reassurance, a successful exit can still produce a poor result. The market does not announce when the bottom has arrived. It becomes clear afterward when the opportunity to invest at that exact price is already gone. Many people picture market timing as one brilliant purchase. In practice, it requires repeated decisions made with incomplete information and real emotional pressure. The timing problem often begins with a reasonable goal. You want to protect your money from losses and invest when conditions appear more favorable. But the most attractive prices often appear when the economy and headlines feel least reassuring. Lower prices usually arrive with a reason to feel nervous. By the time the outlook feels safe again, prices may have already recovered. Emotional comfort and attractive investment prices rarely arrive together. Even if you correctly believe the market is expensive or the economy is weakening, that does not tell you exactly when prices will fall. You can be directionally correct and still lose by acting too early, waiting too long, or failing to reinvest after the anticipated decline. Waiting carries its own risk. The market may continue rising, and each increase can make returning feel even more difficult. The lost progress often begins when regular contributions stop. Money intended for long-term investing accumulates in cash, while the investor waits for a better moment. That cash can become easier to spend because it no longer has a firm assignment. A temporary pause gradually becomes a permanent lifestyle increase. Frequent timing attempts can reverse the basic goal of investing. Fear encourages selling after prices fall, while confidence encourages buying after prices rise. The larger loss may be consistency. Every headline becomes another reason to reconsider a plan that was supposed to operate across many years. Timing the market does not require one correct prediction. It requires at least two. You must know when to leave and when to return. Selling before a decline may feel successful, but the recovery can begin before the news improves. Waiting for reassurance may mean buying back at a higher price. For long-term money, a consistent schedule removes the need to repeatedly predict short-term movements. You still experience volatility, but every month stops being another guessing contest. Suppose you have $12,000 to invest during the year. You could invest everything immediately or contribute $1,000 each month. Now imagine you wait for a correction, but the investment rises 10% before you finally buy. The same assets now cost more. With monthly investing, some contributions purchase at higher prices and others purchase at lower prices. You avoid depending entirely on one entry date. Investing everything immediately creates more short-term entry risk because the full amount could decline soon after purchase. That emotional risk is real, but delaying the entire investment also has a cost if prices rise. Neither choice guarantees the best result because the future path is unknown. A reasonable compromise could be investing $2,000 per month for 6 months. This reduces timing pressure while putting the cash to work on a defined schedule. The key distinction is between a deliberate schedule and indefinite waiting. One follows a plan, the other depends on recognizing a signal that may never feel clear. The better move is to match the strategy to the money's purpose. Cash needed soon should not depend on short-term market performance in the first place. Money for an upcoming home purchase, tuition payment, or major expense may need stability and accessibility instead of exposure to unpredictable market swings. Money intended for retirement decades away can follow a diversified, consistent investment plan without reacting to every economic forecast or market decline. Use the purpose, schedule, and risk framework. Define when the money is needed, establish how it will be invested, and choose risk appropriate for that timeline. Purpose establishes the time horizon. Money needed soon should be treated differently from money that can remain invested through multiple market cycles. Schedule removes repeated decision-making. Automatic contributions continue whether the current headline produces excitement, fear, or uncertainty. Risk determines the allocation. If normal market declines would force you to sell, the problem may be the portfolio design rather than the timing. Wealth Nexus Rule. If the money has a long timeline, follow a schedule instead of waiting for a feeling of certainty. Start by separating money according to when you expect to need it. Do not invest short-term obligations merely because cash feels unproductive. For genuinely long-term money, choose a contribution schedule you can maintain. Tie it to payday so progress does not require a fresh decision every month. If you are nervous about investing a large amount, you do not have to choose between investing everything today and waiting forever. Create a defined schedule instead. Divide the money across several months and invest on predetermined dates, regardless of the headlines. This cannot guarantee a better return, but it can reduce the pressure of one entry decision. Set an end date so caution does not become permanent avoidance. Then decide how much volatility your plan can realistically tolerate. A portfolio that repeatedly causes panic may contain more risk than you can maintain. Before changing the strategy during a decline, review why the money was invested, when it will be needed, and whether those facts actually changed. Review the plan at defined intervals rather than reacting constantly. Changes should follow your goals and circumstances, not every movement in market prices. For more practical guidance on building wealth without chasing financial headlines, you can join the Wealth Nexus newsletter and continue strengthening your plan. If you need help organizing your goals, timeline, and investment readiness, the Financial Blueprint Workbook can help you build those decisions into a broader financial strategy. Market timing is attractive because it promises control over uncertainty. The problem is that successful timing depends on information investors do not possess in advance. Waiting may prevent an immediate loss, or it may cause you to miss gains. You cannot know which outcome is coming when the decision must be made. A consistent plan does not eliminate losses, guarantee profits, or make volatility comfortable. It reduces your dependence on repeatedly predicting what happens next. Your strategy stops asking whether today is the perfect moment and starts asking whether you are following a plan appropriate for your goals. You do not need to predict every market turn to build wealth. You need a sound timeline, manageable risk, and the discipline to remain invested when certainty disappears. Like and subscribe.